The 5x leverage lie, how Binance is harvesting you. On January 28, 2026, the crypto world woke up to a notification that felt like the future had finally arrived. Binance, the world's largest exchange, dropped a bombshell announcement. You can now trade Tesla stock 24 hours a day, 7 days a week, with zero needed for a US brokerage account, no pattern day trading rules, and no minimum balance. It sounds like the ultimate democratization of finance. It sounds like the barrier between Wall Street and the little guy has finally been smashed. But if you look closely at the fine print, it's actually a trap. Because while you think you're buying a piece of Elon Musk's empire, you're actually buying a chip at a global casino where the house controls the gravity. And while you're distracted by this shiny new toy, Wall Street is quietly preparing a trillion-dollar weapon to destroy it. Today, we're peeling back the layers of the biggest lie in modern finance. We're going to show you the mathematical engine designed to drain your account. We're going to expose the secret genius act that turned crypto into a weapon for the US dollar. And we're going to reveal why the real revolution isn't happening on Binance, it's happening inside the very institutions you think are dying. Welcome to the 5x leverage lie. Section 1. The event horizon. To understand the trap, we first have to look at the bait. Let's go back to that morning on January 28th. The marketing machine on Binance Square was running at full throttle. Influencers were screaming about 24/7 gains. Binance angels were posting rocket emojis. The narrative was intoxicating. Why be constrained by the archaic 9:30 to 4 trading hours of the Nasdaq? Why pay hundreds of dollars for a single share? Why settle for normal returns when you can access 5x leverage? It was designed to feel like a liberation. But let's look at the product itself. The announcement was very clear. TSLA-USDT Equity Perpetual Contract. Maximum 5x leverage. Traded using stablecoins. The price is real-time pegged to TSLA on Nasdaq. Sounds great, right? You don't need to exchange currency. You aren't blocked by the few $100 per share threshold. But there is one word here that changes everything. Perpetual. These 3 words determine that Binance's TSLA and Nasdaq's TSLA are 2 completely different species. Many people don't understand this, and they just rush in blindly. Let's break it down. When you buy 1 share of TSLA on Nasdaq, you are buying a small piece of ownership in that country. As a shareholder, you have the right to receive dividends. You have the right to vote at shareholder meetings. And if Tesla goes bankrupt and liquidates, you have the right to get a slice of the remaining assets. These rights are written into the law and are very real. But when you buy a TSLA perpetual contract on Binance, what are you buying? You are buying the price fluctuation. More accurately, you are signing a contract with Binance. The agreement is simple. If Tesla's stock price goes up, Binance pays you. If it goes down, you pay Binance. That's it. Is there any real Tesla stock underneath it? There doesn't need to be. Binance only needs an oracle to bring over the real-time price from Nasdaq. The person buying the contract has not even a cent's worth of legal relationship with Tesla the company. In traditional finance, there is a professional term for this kind of thing, CFD or contract for difference. In essence, it's a derivative. The trader and the exchange are counterparties to each other. So while some people think they are becoming investors, in fact what they're buying is a chip on a gambling table. They are not shareholders, they are just betting on a number going up or down. This isn't meant to belittle anyone. It's a fact determined by the product structure. And once you understand that this is a casino, you have to ask yourself, why did the casino suddenly decide to open this specific table right now? Section 2. The Ghost of 2021. The answer hides two layers of logic. One is regulation, the other is profit. But to understand the regulation part, we have to dig up a ghost from the past. Back in 2021, Binance actually tried this before, but they tried to do it the real way. They listed tokens for TSLA, Apple, and Coinbase. The marketing at the time claimed these were tokenized stocks. They told us that for every token on Binance, a real share of stock was sitting in a brokerage account in Germany. They partnered with a firm called CM Equity AG to hold the actual shares. It sounded reassuring. It sounded backed. But in less than 3 months, the entire experiment was dead. Why? Because they were besieged. The UK's FCA, Germany's BaFin, and the Hong Kong SFC all stepped in almost at the same time. They slapped a label on Binance's stock tokens, unregistered securities issuance. Regulators realized that if it looks like a stock, acts like a stock, and is backed by a stock, it's a security. And you can't sell securities without a license. But there's a darker detail that many people don't know. We only found this out years later after the collapse of FTX. FTX was also using CM Equity for their stock tokens. And after FTX went bankrupt in November 2022, investigators found something terrifying. While the tokens were supposed to be fully backed one-to-one, Alameda Research, FTX's sister hedge fund, was largely just crediting users with tokens on a screen without actually purchasing the underlying shares immediately. They were running a fractional reserve bucket shop. They were printing paper versions of stocks to absorb demand, completely decoupled from the real supply on the Nasdaq. The 2021 model collapsed because it was a lie wrapped in a regulatory violation. So why is it possible to relaunch in 2026? Because Binance learned a valuable lesson. They stopped pretending. They stopped claiming to offer ownership. By defining the new 2026 product as a swap or derivative settled in crypto, they are engaging in a masterclass of regulatory arbitrage. They argue this falls under the jurisdiction of digital assets, a grey zone, rather than securities which are highly regulated. They are no longer selling you Tesla. They are selling you a number derived from Tesla. This subtle distinction allows them to bypass the prospectus requirements that killed the 2021 experiment. It allows them to bypass the need for a German partner. And it leaves the retail trader with even fewer rights than before. But escaping the law is only half the reason they did this. The other half is profit. Because selling you a real stock is a low-margin business. But letting you bet on a stock with leverage? That is the most profitable business model in the history of finance. Section 3. The mechanics of the harvest. Let's talk about something concrete. Let's talk about how the money actually leaves your pocket. Because the 5x leverage lie isn't just a catchy title. It describes a system of mathematical disadvantages engineered into the market microstructure. There are 3 specific mechanisms the exchange uses to harvest you. The first is the funding rate. This is the silent killer. A lot of people don't understand this, so let me explain. Perpetual contracts have no expiry date. To keep the contract price close to the real stock price, the exchange designed a mechanism. If there are too many people betting long, which is almost always the case in a bull market, those long traders must pay a fee to the short traders every 8 hours. This fee is called the funding rate. The key is that this money flows through the system at high frequency. Now, look at the context of 2026. We are in the middle of the Trump pump. Retail sentiment is overwhelmingly bullish. Everyone wants to be long Tesla. This creates a persistent, positive funding rate. If the funding rate averages just 0.05% every 8 hours, that is 0.15% per day. That doesn't sound like much, but here is the trap. That fee is charged on your leveraged amount, not your cash. If you put up $1,000 to open a $5,000 position, that 0.15% daily fee is calculated on the $5,000. That's $7.50 a day. That represents a 0.75% daily decay on your actual $1,000 equity. Do the math. Over a month, nearly 22.5% of your money is wiped out solely by funding fees, even if the price of Tesla stays perfectly flat. You are fighting a headwind that is designed to bleed you dry. And who receives these fees? Ostensibly, it is the shorts. But in reality, data suggests that market makers and potentially internal exchange desks dominate the short side. They hedge their exposure by buying real stock, and then they short the perp to collect your fees. It is a massive wealth transfer from retail speculators to international arbitrageurs. But funding rates are just the slow bleed. The second mechanism is the guillotine, the liquidation engine. When your margin falls below a certain threshold, the exchange doesn't send you a polite email. It instantly sells your position to recover the loan. If the market is thin, which it often is on weekends or overnight, this forced sell order drives the price down further. This triggers the stop loss of the next trader below you, and the next, and the next. This creates a liquidation cascade. Traders call this a scam wick. The price crashes 10% in a second, wipes out all the leverage, and then instantly snaps back to normal. The assets didn't lose value. The leverage was just flushed out. And research suggests these engines are often front-run by high-frequency algorithms. An algorithm sees the cascade starting. It places buy orders deep at the bottom of the wick. The liquidation engine dumps your position into their buy orders at fire sale prices. They buy your Tesla exposure for pennies on the dollar and sell it back seconds later for a massive profit. That's why I say that perpetual contracts are an upgraded version of a casino. Once you understand this underlying logic, you won't blindly throw your net worth into it. But while you're busy fighting these algorithms in the casino, the real players are building something entirely different. Section 4. The institutional divergence. Okay, now that we talked about Binance, let's turn our gaze across the ocean. While Binance is busy launching contracts, the NYSE and Nasdaq are not sitting idle. But what they're doing is much bigger than Binance and much deeper. They are working on true stock tokenization. This isn't about letting you bet on price action. This is about taking the ownership of traditional stocks and rewrapping it using blockchain. The token you buy is backed by real stocks. The rights you enjoy are exactly the same as buying on the NYSE: dividends, voting rights, liquidation rights. Why does the NYSE want to do this? Haven't they always looked lukewarm toward cryptocurrencies? The answer is simple: they're scared. Let me give you a data point and you'll understand. From 2020 to 2024, global young capital flowed massively into the crypto market. Their logic is simple. The crypto market trades 24/7. It's exciting, it's always available. What about US stocks? The market is only open a few hours a day, closed on weekends, and there's a ton of overnight gap risk. For young people who are used to crypto, the traditional stock market feels broken. So, the NYSE's strategy is, if you can't beat them, join them. They want to transform themselves into something as easy to use as a crypto exchange. But their real target isn't Binance. It's a huge monster within their own system called the DTCC, the Depository Trust and Clearing Corporation. In the US stock market, the settlement behind every trade is handled by this institution. Right now, US stock settlement is T+1. Stocks you buy today only officially settle tomorrow. Inside that one-day time gap lies enormous profit. The DTCC charges clearing fees, and market makers like Citadel Securities use that lag to arbitrage order flow. Have you heard of payment for order flow? This is how Robinhood makes money. They sell your orders to market makers. Citadel made billions of dollars per year from this. Where does that money come from? From the pockets of retail traders who suffer slightly worse execution prices. But the NYSE is building something called Project Ion. It uses blockchain to achieve atomic settlement. In a single transaction, asset transfer and payment happen simultaneously. No intermediaries, no waiting, done in 10 seconds. Once this is in place, the DTCC's reason to exist disappears. The market maker's time arbitrage window disappears. This is a $1 trillion redistribution of benefits. So, when the NYSE moves on-chain, it's not just embracing technology, it's seizing the chance to kill the middlemen. Better to lead the revolution yourself than be overthrown by others. And the institutions have one more massive advantage over you. It's called BUIDL, BlackRock's institutional fund. In late 2025, exchanges began accepting BUIDL tokens as collateral. This creates a structural disadvantage for retail. Think about it. You deposit $100,000 in USDT to trade on Binance. That money pays you zero interest. It just sits there, losing value to inflation. But an institutional trader deposits $100,000 in BUIDL tokens. This asset pays a 5% risk-free yield derived from US Treasuries. Before a single trade is placed, the institution is winning by 5%. You are losing by 3% inflation plus funding fees. This 8% differential means the institution can afford to be patient. They can afford to hedge. They can withstand the volatility that wipes you out. It is a stacked deck sanctioned by the new market structure. And that brings us to the final, most disturbing layer of this story. Who sanctioned this? Section 5. The Genius Trap. We need to talk about the Genius Act. Signed into law by President Trump in July 2025, the Guiding and Establishing National Innovation for US Stablecoins Act fundamentally reshaped the landscape. On the surface, it looked like a win for crypto. It gave stablecoins a legal identity. But deep down, it was a geopolitical masterstroke. Analysts at Citi call this Eurodollar 2.0. For years, the US government viewed crypto as a threat. But then they realized something. USDT and USDC combined now exceed $300 billion in scale. Those stablecoins circulated all over the world. And under the Genius Act, they are required to be backed one-to-one by US Treasuries. What does this mean? It means that every time a trader in Vietnam or Nigeria buys USDT to trade on Binance, they are effectively buying US government debt. The Genius Act effectively sanitized the chips to benefit the US Treasury. But here is the catch. The Act prohibits stablecoin issuers from paying interest to the end user. This was done to protect commercial banks. But the consequence is that it forces holders of stablecoins to seek yield elsewhere. Since you can't earn 5% by simply holding USDT, you are incentivized to deploy that capital into the casino to chase returns. You are incentivized to open that 5x leverage long on Tesla. So the system works like this. Retail capital flows into stablecoins, funding the US debt. That capital is then deployed into the casino, where it is harvested by funding rates and liquidation engines. The retail traders' losses eventually flow back into the system via the reserves of the issuers. The degen is unwittingly funding the US deficit. This is why US regulators have allowed this to happen. They realized that instead of cracking down on crypto, it was better to bring it under control. Let the stablecoins operate under regulation, and the digital expansion of the dollar becomes even smoother. This is dollar hegemony 2.0. And Binance? They are just the venue. They are the useful utility that keeps the demand for stablecoins high. Why is Binance rushing to list TSLA contracts now? Defense. If Binance doesn't do it, Coinbase will. Coinbase is fully capable of launching a compliant, truly tokenized stock product. So Binance has to occupy this niche first. Even if right now it can only offer contracts and not real tokenized stocks, it still needs to keep the users. It's a game of survival. So let's zoom out. On the surface, Binance and the NYSE seem to be moving in the same direction, putting stocks on chain. But they are building two completely different worlds. Tier 1 is the institutional world. It is characterized by ownership, atomic settlement, and collateral yield. It uses blockchain to make the system safer and more efficient for the big players. Tier 2 is the retail world. It is characterized by synthetic exposure, perpetual debt, funding decay, and liquidation risk. It uses blockchain to gamify trading and extract liquidity from you. Some people confuse these two things. They think that buying a TSLA contract on Binance means they're participating in the historic process of stock tokenization. They don't understand they've just walked into a casino with new packaging. When Binance invites you to trade TSLA with 5x leverage, they are not inviting you to invest in the future of transportation. They are inviting you to sit at a table where the cards are marked, where the chips are depreciating, and where the dealer knows exactly how much you have left to lose. The revolution will be tokenized, but for the retail trader, it will not be televised. It will be liquidated. Don't be the exit liquidity.